David R. Guttery is the president of Keystone Financial Group in Trussville, Alabama. David Guttery and Seth Edgell are financial advisors who represent Emeritus Investment Company, LLC, and Emeritus Advisory Services. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone, I'm joined today by David Guttery, President of Keystone Financial Group, to share his thoughts as we bring this year to a close and look forward to 2024. David, thanks so much for being with us. So, throughout the year, we've talked at length about navigating palpable sentiment and the Federal Reserve, inflation, and the economic backlash of all things related to the COVID crisis. But you're here today to share your optimism about the coming year. Is that correct?
Yes, that's true. Within our previous video, I drew reference to the stock market crash of 1987 and how such periods of turmoil can occlude the vision of the markets. Well, as time passes between now and the origin of the angst, you get proximity with time. With proximity, you get a return of vision. With vision, undervalued opportunities become increasingly clear, and before you know it, markets begin to reprice risk in a positive manner. I think we're beginning to see this happen. I don't believe that we're necessarily out of the woods, but to quote Winston Churchill, this isn't the beginning of the end, but it may indeed be the end of the beginning.
Well, that sounds encouraging. So, David, you've talked often about inflation and how that has been a major source of concern over the last 3 years. Do you see any encouraging developments with that issue?
Oh, absolutely. Recently, there was a survey suggesting that 58% of respondents felt that inflation was an emergency. Not a problem, not an issue, not a nuisance, but an emergency. By the data, would you believe me if I told you that the rate of inflation is back to where it was prior to the pandemic? It is. Most people don't feel it, however. This isn't a data issue, it's a duration issue. Our capacity to consume has only been empirically positive over the last 3 months. Well, 3 points of data will not outweigh 36 points of data. I need to see 15 more of these data points where inflation is lower than the degree by which our incomes are rising before I can have confidence that attitudes toward consumption might change. Indeed, Dr. David Kelly recently observed that we have a bottom decile attitude toward a top quartile economy. Well, the good news about sentiment is that it eventually fades. And as it does, the investment landscape changes in perspective as well. I believe that if this recent pattern of inflation remains in place, that increasingly positive attitudes toward consumption could lead to greater patterns of consumption, which then potentially sparks a shift away from being efficient to expanding the capacity of plants to manufacture more of that which is being demanded in greater quantities. I believe that could potentially unfold in 2024 and be a positive thing for market participants.
Well, I had no idea that inflation had indeed cooled to this degree. And it makes sense that it might take time for consumers to actually feel that improvement. Well, David, you've also talked a lot about the Federal Reserve and how market participants have seemingly feared that the Fed might revert to a more hawkish posture in the future. Has there been any improvement with this area of concern?
Indeed, I believe so. Again, in my opinion, market response is a function of the magnitude of the shock. I believe that the Fed shocked the markets with its approach to removing accommodation. Was the Fed just opaque and ambiguous, or did the markets misinterpret the message? It's been my contention all along that the Fed was clear that the goal was to remove accommodation. Initially, they offered little in terms of scope and timeline, but we knew that a massive amount of accommodation would be taken back. I believe the markets conflated this with solely the fighting of inflation, and I believe that was the wrong conclusion to draw. I believe market participants were expecting a longer and more tepid approach to the removal of accommodation, similar to what we experienced in the 2015 tightening cycle. What we got was Paul Volcker 2.0 and the most aggressive Fed in 40 years. This was a shock to the markets. The greater the magnitude of the shock, the longer it takes from which to recover. So the question becomes, has the Fed done exactly what they said they were going to do? Yes, I believe so. In November of last year, Chairman Powell told us that the Fed would be less hawkish, more data-driven, and judicious with future policy decisions. Well, it looks like they've done just that. You can see this chart obtained from the Fed's website, and indeed, the slope of the 2023 line is much less steep than the slope of the 2022 line. By the numbers, it's even more evident. But I don't think that fixed income or equity market participants actually believed it until possibly just now. Looking at this chart, it would appear that by the actions of the Treasury market participants, there is now a discernible shift just since Thanksgiving about where market participants believe future Fed policy decisions may land next year. The Fed has been conveying the same message now for 13 months. Seemingly, only now has the Treasury market heard it. I think this is a positive development as we launch into the new year.
Interesting. Well, David, you've spoken before about how, in your opinion, the market is broadly undervalued and seemingly being led by a narrow basket of AI thematic companies. Well, in your opinion, what can you tell our viewers about broader market metrics as we approach 2024?
Indeed, that remains true. Now, I can't get into a discussion of specific stocks in companies in a format such as this. However, I do believe that the overwhelming majority of the market remains very attractively priced when viewed from a forward PE perspective and other metrics. Recently, I found this stochastic view of the market. At a high level, stochastic analysis is simply observing points of strength and resistance and then connecting those dots to form Bollinger Bands. When you hear that markets are bouncing off of strength or running into resistance, it is to these Bollinger Bands to which reference is being made. Looking at this graphic, it would appear that a cone convergence is underway. That's exciting in and of itself, but it is even more exciting to see that the 50-day moving average and the 200-day moving average and the current valuation of the market are seemingly converging at the same time. Something's about to happen. Any good stochastician will tell you that if you breach a Bollinger Band and close above or below that level, there is a good probability that you will establish resistance or support levels at a 10 to 15% higher or lower level than previously before. Well, notice that the blue line and where the S&P index was just 3 weeks ago, as it was flirting with that upper level resistance. Since then, we've heard from Chairman Powell following the December Fed meeting, and the market closed well above that upper level of resistance. That's a good technical indicator, if you're into such things, that we might be positioning ourselves for a reasonably green 2024.
Well, what about the election cycle next year, David? Might that have an impact on market performance and perception?
In my opinion, the House races might have an impact on market sentiment. Spending starts and stops in the House. The most recent auction of new 10-year Treasury debt did not go very smoothly, and there remains concern over whether the Fed can land this removal of accommodation softly. The Fed is unwinding its balance sheet, and the world is flooded with an overabundance of U.S. Treasury debt. We've talked about this in previous videos. The more spending we have in Congress, the more new pieces of debt that we auction. And if the last auction is any indication, those yields will be increasingly higher due to the overabundance of supply that we have on the open global market. That is a headwind to the Fed's attempt to land the removal of accommodation softly. If the disposition of Congress is more conservative, however, then by extension, we can assume that spending might curtail and result in a lesser quantity of new debt than we might have had otherwise. And such, in my opinion, would be viewed favorably by the markets as a tailwind to the Fed's efforts. Also remember that by the statistics, markets generally perform well in an election year.
Well, so in summary, as we prepare for the beginning of a new year, can you connect these dots together and leave our viewers with an understanding of why you're optimistic about 2024?
I'll do my best. Inflation has been falling at a faster rate than the degree by which our wages have been rising at a declining rate. Purchasing power has been less negative now month by month for over a year. Now it's empirically positive. Consumer confidence is rising as a result. The Fed, in my opinion, has signaled that it is likely at the end of its endeavor to disincentivize lending and borrowing. The inflationary rate of change is back to where it was before all of this mess began. Bond yields have, in my opinion, spiked and are now floating down and present less of an allure away from equity markets. Stochastic data is pointing in a positive direction. The economy seems to be in okay shape with tepid growth forecast for the coming year, but this, in my opinion, is a much better outcome than for which the markets may have anticipated 3 years ago. Are there still some concerning areas? Sure, which is why I said earlier that this might only be the end of the beginning, but I do believe that much of what the market had feared and priced into valuations has either not come to fruition or has come to fruition in a much more docile manner than anticipated. There are no ringing bells or alarms to signal when palpable sentiment begins to dissipate. This is why you must find the intestinal fortitude to be this guy, the jet fighter pilot on vacation, when it comes to resisting the urge to succumb to sensationalism and speculation. Rise above, think outside the box, and remain focused on long-term and the fruition of planning goals.
Well, David, as always, thanks so much for this information today and for additional information. David may be reached through the means listed upon the following screen. For the Trustful Tribune, I'm Brandon Dawkins.
David Guttery and Seth Edgell independently offer securities and investment advisory services through Emeritus Investment Company, LLC, member FINRA, SIPC, and Emeritus Advisory Services. Information provided in today's segments is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.